In terms of 18, the year, the highlights of it was that we did revenue at $373.2 million, which is $3 million up on 17. EBITDA was down to $50.7 million and that was 15.8% down on 17. And as you know, in prior period to Christmas, we had the big influenza outbreak. That had a severe impact on our occupancy. Our occupancy dropped and took some time to recover. We told the market that would be the case, and we said that we would get back to historic levels around 94.5%. And as at June this year, we were at 94.4%, and we're continuing at that sort of occupancy rate. So the blip came and is now gone, but it did have an effect on EBITDA. And the other main impact on EBITDA was the government funding cuts and ACFI indexation. And I'll talk about where we are in respect to government activity later on. The pleasing thing is care. So as you know, we focus very hard on a high care model. Our accreditation record was maintained. 19 facilities went through re-accreditation during the year, which was quite a large number. And we got 44 out of 44 of the outcomes there. We had a big capital expenditure program during the year. We spent $108.2 million on land and developments mainly. We had net RAD inflows for the year of $41.6 million. That was very pleasing, and that was about $6 million more than budgeting. And there is some commentary in the market about cash flows and what's happening with your RAD capital inflows and whether there's pressure there. We don't see that in the Japara business. We got a good outcome this year, and next year we're looking to substantially increase the number of RAD inflows we receive above that $41.6 million. The net debt of $116.3 million represented $30.3 million of core debt and $86 million of development debt. Chris will talk about where that's going over the course of the next year. It will increase as we undertake the development program that I'll talk about later on. In terms of the highlights, from a greenfield development point of view, we completed the Riverside Views aged care facility, which is 88 places, and we are actually have another 220 places and 3 homes, which will open in the next 3 months. So a lot of building activity in the year. In brownfields developments, we did 136 premium rooms, which were delivered in the last 18 months, and we got 101 under progress. Significant refurbishment, we did 6 homes in 18, and we're doing a further 8 in 19. Currently, 21 homes qualify for our maximum accommodation supplement. And in acquisitions, we successfully did the Riviera Health acquisition in Sydney. There's 210 places plus 297 surplus bed licences. It gives us a significant increase in the presence in the Sydney market. I'll talk through later on what that means to us, and we think it will deliver more than $3.5 million in EBITDA contribution for FY19, and that's a platform for where we go to in terms of our forecast for FY19. So I'll hand over Chris now, and he'll go through some of the key operational and financial elements, and then I'll come back and talk about some of our strategic initiatives and what we're going to deliver.
So this slide is a bridge between the FY17 result and the FY18 result. It's focusing on our recurring EBITDA. On the upside, we had completed 4 brownfields during the FY17 year, and we had a increment of $3.9 million from those into FY18. 2 of those, Kirralee and George Vale, are included in the case study in a later slide. We also had operational initiatives. The key one is our roster restructure program, which we have talked about previously, where we have reviewed 14 homes in the first half of FY18, 15 in the second half of FY18, and we're doing another 15 in the first half of FY19. So we expect further uplift in FY19 because we're getting a full year increment from those, and we've got the new rosters coming through. Wage rate increases were 6.4 million. That equates to about 2.5%, which is, and we'll expect a similar number this year. What we didn't have in FY18 that we will have in FY19 is that there's no ACFI indexation. So one of the issues we had this year is that we've got the wage rate increases, but we have had no offsetting ACFI increases. And we also touched on occupancy. So there was influenza outbreaks were about 5 times the normal level across Australia last year, and that hurt our occupancy in the first half. It has then slowly rebuilt over the course of the year, but we estimate the earnings impact of that was about 2.7 million. So they're the key moving elements. I've also included the non-recurring items. That's a net 3.3 million. We had a gain on the acquisition of Riviera since we bought it at such a low price, but we had some non-recurring costs like redundancies and the capital refurbishment deduction wind back. So in the previous year, that figure had been 6 million, so a higher number. So this slide is a bridge between our debt levels year on year. Our two key cash inflows are from operating activities where we had 35.5 million and net RAD inflows of 41.6. That RAD inflows are about 10% above what we had budgeted, so we're quite happy with that performance. On the spending side, our main investments were in the development program, so we've spent nearly $100 million on land and developments. The other key item there is the Riviera acquisition. So there was, including transaction costs, we were at 40 million on acquisition outlay. We think the year will probably close at about 150 million in net debt, and beyond that will stay below 200 million. So you'll see in a later slide that we've elongated the time frame for the development pipeline a little bit. That's partly around the development team capacity, around operationally just about the speed you want to bring them in, and about managing our cash flow. So we're looking to bring in about 300 to 350 new beds online per year. And as we've got RAD inflows beginning at matching the cash outlays, we expect to stay below 200 million. The next slide, number 8, is key operational metrics. I'll just touch on a few here, a few of the key points. Underlying occupancy, you can see, fell in the first half to 92.3%, which was a result of the influenza outbreak we mentioned earlier. It was 94.7% in the prior half. It is now recovered to 94%. In fact, finished the year at 94.4%. So we did get a recovery in the second half, which was pleasing. The other key line is the staff cost per revenue. That's always been a subject of discussion with Japara because we have a sort of a high care model, a nurse-heavy model. So our ratio was 70.7% in the second half of FY17 has been quite high. We have been undertaking the roster restructures, as I mentioned, so that has come down to 69.5%. It will probably come down another percent or so, we feel, like to maybe the mid 68%. That has been helped as well by the rollout of a workforce planning system that has also helped us get some wage efficiencies. The third item I'll point out on this page is the average incoming bed contract price. You'll see that it had been increasing and then fell from 350 to 323,000 in the second half of FY18. We had a specific program to lower prices at some of our homes, so we targeted particular homes and particular beds in those homes. So it wasn't a blanket approach. We did that to increase occupancy, and it's been quite effective in doing that. The trade-off, obviously, is a lower incoming room price. What we are now doing is increasing those room prices. So at 4 of the homes, we've increased them in the last 6 weeks or so, and we'll continue to do that over the next 6 months. So once they get back to an occupancy level we're happy with, we re-increase the price. This slide sort of reinforces the point we were making about occupancy. So the chart on the right shows the average level of influenza cases reported to the Department of Health per annum. You can see 2017 as I said, was about 5 times other years. The pleasing thing here is for the community in general, but also for where our results go, is that the 2018 level looks lower than usual. I mean, it's not a certain predictor of the future, but it looks to be on the low side. Our outlook, which we'll talk to later, assumes that we maintain our occupancy in the sort of mid to high 94%. So we're not assuming that there is a repeat of last year's influenza outbreaks, which at this stage seems a reasonable assumption. The chart on the left is sort of the inverse of the chart on the right, and it shows that the correlation between influenza and occupancy. The room price and resident mix trends. That chart on the bottom left shows the fall in average incoming room price. That's not the room price, I might add, for the total portfolio. It's just the incoming room prices, so it is quite sensitive. The one on the chart on the right and in the bottom right shows the preference of incoming non-concessional residents between paying a RAD, a DAP or a combination. And what is sort of interesting with this is a lot of commentators on the sector have been, for the last 2 years, concerned that there's going to be a shift away from RADs towards DAPs. And, we're just not seeing that. Really, for the last 18 months, it's been a trend back up towards RADs. I think that is partly caused by our development program as we're sort of bringing on premium rooms in metropolitan locations. People who can afford to pay a RAD will pay it. We get asked, when is it best for someone to pay a DAP? When is it best for someone to pay a RAD? We've spoken to a number of financial planners, and they say people pay a RAD every time if they can. No one wants to pay at MPIR at nearly 6%. This is the last slide I'll talk to. This shows the RAD liability movement. So it's essentially saying from our mature homes we had a RAD cash inflows of 23 million, and the balance was from greenfields and brownfields. We expect that 40 million or the 41 million we've had this year will roughly double next year. We'll probably get a little less from mature homes because I think that figure will run down over time, but because we've got a strong development program, we should get a big uplift in our greenfield and brownfield RAD flows.
So I'll just go through some of our strategic initiatives, and as you know, our growth plan comprises 4 or 5 key items. One is the brownfield and greenfield developments. The next one is operational efficiencies within our business, which is where we have been realigning our roster restructures, or rosters to get some restructure done there. The next one is the acquisition platform that we have. And the final one is the sort of what I call the continuum of care model, which is moving into product which has got senior living, health elements to it, and aged care. So in terms of the development summary, we have a program that now comprises around 1,200 net new places, and we're expecting to have that delivered over to 2022. The pipeline comprises 5 brownfield developments, 12 greenfield developments, and 8 significant refurbishment homes. The pipeline that we've now got delivers around 300 places per annum on a consistent basis. It ensures that we can commission those up effectively and manage with the internal resources we have, and it ensures that our peak development debt is managed conservatively, with the RAD capital inflows meeting construction capital debt that we pick up. So it's a very good pipeline. It's going to be delivered over the next 4 years, and as I've said before, we're expecting to generate in excess of $25 million of EBITDA once this pipeline is completed, and the construction costs for the pipeline will be covered by new RAD capital inflows. Let me talk about the acquisition of Riviera Health. So the headline number for that was $38 million. The Brighton Le Sands facility, which is due for completion in October, so we bought it mainly completed, but there were issues with it that we knew about in due diligence, and we spent some money to fix it up. So we are going to open that in October 2018. We expect to receive more than $20 million worth of RAD capital out of that, so 38 million less 20 is 18. The valuation that we have got independently suggests that the land is worth, the surplus land in the portfolio is worth 7, and that the bed licences that are surplus are worth in excess of $10 million. So you get down to an effective no money paid for 210 operating beds on 4 homes. The 210 operating beds will go to 265 once we get Brighton Le Sands commissioned and open. So on this slide, it shows you exactly what we've got now in Sydney. We have Bayview Gardens, 62 homes. We have Chatswood, 62 beds, We have Chatswood, which is 50 beds, and we're going to be doing refurbishment on that. Brighton Le Sands will ultimately be 88 beds once we complete the total development there. Doonside is 60 beds. Wyong is 70 beds. And then Belrose, upon completion, will be 105 beds. We will, however, on the 4.3 hectares of land that we acquired as part of this transaction, build a 120-bed development on a new Wyong site and relocate the residents to that site. So we will have a portfolio in the Sydney market of basically brand new facilities of around 500 beds, which is a very good platform and it's superior. When you look at the map on the right-hand side of slide 14, it gives you an indication of the locations. And if you take sort of a semicircle from Belrose through to down Doonside and down to just below Brighton Le Sands, it's in that semicircle that we've identified 3 optimal locations where we will be looking to buy sites and build new facilities. Right, so that's the strategy, to go from 1,200 beds to another 1,200 beds. And in the Sydney market, we've got 3 or 4 locations where we'll be buying sites and land banking for that development program. So if you were to assume 120 beds for those sites, you get another sort of 400 and 500 beds. So we're planning to get a 1,000-bed portfolio plus in that Sydney marketplace over the medium term. On page 15, it's just a summary of the recent or near-term developments that we have done. So Noosa is now completed. We've got a really interesting product on dementia in Noosa, filled immediately, and we've now got a waiting list. Riverside Views is finished and open. Glen Waverley opens in September. Brighton Le Sands, as I mentioned before, opens in October. Rye opens in November. Kingston Gardens opens in September, and Miradong opens in October. All of these projects, I mentioned the $102 million. A lot of the money that was spent in CapEx in that period of time was building these facilities. That started 3 years ago. So there's a lot of new developments coming to the market through Japara, and that will generate significant EBITDA uplift for us. The development case study I've got there, I just would like to put that up because it gives hard evidence to the premise that our RAD capital will cover our construction costs. So these projects that just a couple of examples, on Kirralee and on George Val, as you can see, we achieved significant uplift in our EBITDA. We achieved improved occupancy that led to that uplift in EBITDA, and we achieved RAD capital that paid for project costs. So we've been calling out that we get RAD capital to cover construction costs. This is an example where we got RAD capital to cover project costs. So, for example, on the George Val facility, total costs were about $9 million. We got $12 million of RAD capital in. So we're very confident about our development pipeline and meeting the requirements and the metrics that we've called to the market. On the following slides, there's just a bit more information on our developments. And for your information, in respect of significant refurbishment, same position. We've called to the market our significant refurbishment program will deliver about $4.25 million in extra EBIT. We're halfway through that program. The balance of that will come in 19 and a little part in 20. There are a few more homes that we will do significant refurbishment on that will throw more revenue into 2021, but not to the extent that we've been able to achieve in the front end of that program. But that's very positive. The next slide is just the more detail on the Riviera acquisition. Now, this slide. This is a new slide and really important. and this is the discussion that I'm having with Canberra. I'll just simply, before I go through that, I'll talk about what actually happened. When we had the budget cut, it was on the premises that ACFI funding was going to go at 6.8% per annum, and that's what it was occurring for that year. If you projected that 6.8% per annum out over 4 years, there was about $1.2 billion of funding that was not funded for. The government said, we haven't got the funds for that, okay? So we need to cut ACFI down, and it was in the complex care area, and we need to cut it down so that it then runs at about 5.5%, 5.6%. So from between 5.5 and 6.8 or 6.9 for 4 years equaled $1.2 billion. Okay, that was the premise of it. What we said to them is that, to the department, that's not going to happen. What is actually going to happen is that 6.8 might run for a little bit longer, but it's because people are coming into our premises later, into our homes later, and they're coming at higher level of care. So a person who came in at 180 ACFIC, all of a sudden the next person came in, we got 186 or 189. And it was that change in the market, that step in time, that caused that 6.8, 6.9% growth. And then when we get through that environment, it's going to then smooth out. So you've cut too hard. That's what we told them. They said, being the department said, we'll wait and see what happens. Well, what actually has happened is exactly that. And so this graph shows two important things. The orange line is the government projection. The dark line is the actual. So you can see in the June, September through to probably, December 15 or thereabouts, the funding projections were less than actual. So government was sort of overfunding in there, and that's why the cuts occurred. Since December, we've had a realignment of it, but since June 17, when the cuts have really come in, we've got a situation where our actual revenue is now below what government had funded. So the funding is expected that they were incurred is now actually less than what's actual. So we are talking to the federal government about the premise of, which they've always said, if ACFI runs at a higher rate than projected, we will cut it down. If it runs at a lower rate than projected, we will turn it up. And so we're talking to them about that right at the moment and trying to find a short-term solution to what actually is happening in the industry at the moment, which is your slight negative jaws. Right? So, and we continue to discuss that with Canberra and other locations. Then we'll go just onto the real estate portfolio and where we now sit to give you an update on that. We now have $532 million of book value in our real estate portfolio. We have 4 leased facilities in that. We have $156 million of book value on developments. We have $33 million of accommodation-related payment. You could align that with the $532 million because it's real estate related. 85% of our rooms are now single bed. That's just come down a little bit because when we took over Riviera, there were quite a few 2-bed, 3-bed wards in there that we're now bringing back. 78% of our places are in metropolitan or major regional locations. When I talk regional locations, I'm talking regional cities, so Ballarat, Geelong, etc. And we have 180 independent living units. And then there's a good snapshot of where we are from a geography perspective. So now I'll go into summary and outlook, and I'll head to 2019 outlook, just summarise that, and then Chris is going to come up and actually give you more detail around those items where we, as to why we're predicting that the FY19 EBITDA is going to grow by 5 to 10% over the FY18 EBITDA. Where that's going to come from is the operational initiatives gain further traction. Occupancy will continue to normalise, so we bring back the loss of EBITDA we got from the occupancy drop as a result of the influenza outbreak. ACFI indexation returns, but on the other side we've got wages inflation. We've got the significant refurbishment program, which is 2.5, the Riviera Health portfolio, which is 3.5 million, and developments opening up are going to be about 1.5. So, Chris, I'll call you back and you can go through that in a little bit more detail.
Thanks, Andrew. Just to give a bit more context, and so we're all clear, the 5 to 10% increase that we're talking about is on the base of 50.7 in this year, so not the 47.4 but the 50.7 in total, and it excludes any property gains. That's not to say we won't do any real estate sort of value initiatives, but we wanted to make sure that people who are covering the sector are looking at it on the same basis. So it excludes any of those. So I'll just go through a bit more detail each of the components that sort of lead us to that range of increase. On the first slide I spoke to was the bridge on performance FY17 to FY18, and I mentioned roster restructures as the main initiative around operational improvement, and that is so that will keep on playing out. So the restructures we undertook in FY18, we get a full year increment in FY19, and we have got the FY19 new ones we're running as well. So about the same sort of number, maybe a bit more is what we'll be looking at there. Occupancy should be back to normal levels for the full year. So you might again recall from the first slide that we dropped about 3 million in earnings on that basis. We would expect to have a normal year on occupancy, on a slightly bigger business as well. ACFI indexation returns, it's at 1.18%. The maths on that are fairly easy. It gives us about 3.2 million. I'm not telling you anything particular there. That's just that's easy to work out. And the wage inflation, we should be about the same level as the year that has just gone as well. So our EBAs, our primary EBA is in Victoria, where we've got 70% of our homes. That has got increases of 1.25% every April and October. In the other states, we average 2.5% per annum also, but they're on annual increases. And the support office also adopts the same rate as the EBAs. So that's what we're expecting on wages. Significant refurbishment program, that is tied to the increase we get on concessional residents for accommodation supplement. So once you've completed a significant refurbishment, you get an extra $19 a day for each of your concessional residents. If you're in a home that is above 40% concessional ratio, all our significant refurbishment program is at that level. So, behind the scenes, that's simply a matter of saying, well, what date do they become significantly refurbed? How many concessional residents are there times $19 a day? That's the number. So we can be quite exact on that. We have got pre-approval on our significant refurbishment program, so we know once they're completed, they will qualify for the uplift. Riviera Health portfolio. The 3.5 to 4 million, we've sort of been consistent with that. I suppose it's come on in the first 3 months. Performance is what we expected. We're expecting a sort of an improvement in performance over the next 6 months, and then we'll get an annualised run rate. So this has got some 6-month ramp-up period. This doesn't include earnings from the new Preston House home. This is really on the business as it is. And then we've got a number of developments that are coming online. And the number here, the 1.5 million, is the net of a stronger uplift than 1.5 from developments that have been completed and are now running, like Noosa, like Central Park, like Riverside. And then we've got some of the new developments where they start up making a loss. So Riverside, for instance, took 7 months before it hit break even. We'll expect something similar on these other homes. So that's a net figure. So that just gives you a little bit more sort of detail on how we have landed on our guidance. And obviously we'll be able to talk to that when we do our next roadshow about how we have gone on each of those items. Just one other point to help with your modelling: depreciation uplift or increase we're expecting about 3 to 4 million. And our tax rate, which this year has been 21%, we're expecting will return to the normal 30%. It was 21% tied in with the Riviera acquisition, but it will go back to the corporate rate next year.